Welcome, everybody, to another edition of our Foundational Strategy Trading and Backtesting series. Today, we'll be talking about the Strategy Performance Report and how we can see how our strategy performed historically and what metrics we need to look at to see if there's a chance that the strategy will perform well trading forward. I'm joined today like I always am, by Tom Snyder, CMT. Tom, thanks for being with us.
Mike, it's my pleasure. How you doing today?
Good, good, good. So this is a topic that I think is key for strategy trading. Let's just level set a little bit here. The idea here is that strategy trading is really a positive step for a trader, someone who wants to become a trader. Strategy trading allows you to kind of do to get a deeper understanding of market behavior, price movement, and how different indicators react with the market, right? So, I think you agree with me. What else do you think here is key about strategy trading?
Well, I think it's just the concept of taking an idea that you might observe in the market and applying it to historical data so you can see how that idea might have performed if you had put trading rules around it. So that idea might be as simple as a price crossing a level or price crossing an indicator, or it could be more complex where you introduce several indicators or other conditions to kind of represent your idea of what's happening in the market and where you might find favorable trade conditions. How would that have performed? And instead of doing that visually, right, looking at it trade by trade, there's certainly room for error when we do that. This actually is automated in the sense that, well, just look at the data and apply these rules to the data. So it is really not only just a key thing to evaluate trade ideas, but it's also an efficiency tool as well.
So I kind of think of it as an essential feedback loop, right? That allows you to look at many of the different metrics and elements that make up the performance of your trading strategy, and that's what we're going to be talking about today. Is that strategy trading report here in the NinjaTrader platform. So to get started, Tom, I'm going to start with a chart. In order to bring up the performance report, we have to apply a strategy to the chart. Now, I already have one on the chart, so let's take a look at that chart. And I'm going to show you what we have here is a simple moving average cross strategy. This is a sample that comes with NinjaTrader. And I've set the inputs to a 3-bar moving average, which is the gold line there, crossing a 10-bar moving average, which is the green line there. And on the chart, the strategy goes back, and everywhere there's a cross, it creates a strategy entry and exit for each of those trades. It's reversing, going long, short, long, short. And it compiles all of those trades into our performance report. So just to level set here, I'm going to right-click on the strategy on the chart and show you how you add a strategy into the chart. So on the strategies dialog, there are some sample strategies here. I'm working on some of my own strategies as well. But you select the strategy that you want to add to the chart, click Add, and bring it into the chart here. Now, there's something really important here I want to point out, and that is that there is an Enable button here on the right. A lot of times people will try to work with strategies and nothing ever shows up on the chart. And the reason that is because they haven't enabled the strategy within the chart. So that checkbox is really important. And then once you do that, you've got the strategy on the chart. In this case, this strategy also inserts the moving averages, which is super convenient. A lot of times if you have custom indicators, you have to put those on the chart, and then you put on the strategy and make sure that the rules line up correctly. But in this case, it's done for us automatically, which is really nice.
And that gives you the ability to check that the conditions for trading are represented correctly, right? So you can see the studies and where you would expect trades to happen, they actually happen. I want to say one thing about that enabled button because it has perplexed some people, including myself, I know. It's there kind of like to lock in the variables of your strategy. So think of it as we're in 2 modes. One is an experimental mode where we can tweak the dials and levers, but once we've got those dials and levers tweaked the way we want, we lock it in and then we see the display. That's the enable button.
Yeah, that's a super good point. To your point, to your point earlier in evaluating the price action to the indicator and seeing those buy and sells on the chart, every indicator and every strategy in NinjaTrader is written in NinjaScript. And so the rules for your strategy are in that NinjaScript. And so you may have an idea for a rule, but did those ideas get properly translated into NinjaScript? And is it generating the trades exactly the way you think they will? So that's a key point. I'm going to right click and go to strategy performance. This is where we can bring up that strategy performance report. We're looking at the sample moving average crossover, and we're going to look at this historically. So Tom, talk a little bit about the chart environment. We're looking at a daily chart of ES. That's really kind of the environment that we're backtesting in, the laboratory, so to speak.
Exactly. And that's something you need to define. I mean, it's defined for you when you apply the strategy, kind of takes a default view. But there's three things we need. We need a market that we're trading. That's the symbol. That's the ES September 24 that Mike has up there. You need a periodicity, in this case daily, and then a date range. So you kind of set the start and end of the data that you're looking at to evaluate your trades. In this case, I think we go back to the beginning of this year, but you could certainly test different date ranges, which is, I think, a really key part of, getting into the weeds with strategy testing, because, the whole idea is we just don't want to test a little slice of the pie and then assume that this is the best strategy ever and let's go forward. You want to do different slices of the time history that you have and test that. But those are the three things we need for the laboratory environment. We need a symbol, we need a periodicity, and we need a range of that data. And you can see here, right in the second, let's call it section, start date and end date. That's where I know that this started at the beginning of the year.
Yeah, that's a really good point. Let me do a little bit of geography here on the performance report, and then we'll talk about some of the actual metrics here. So when you bring up the performance report, you get the initial summary page, which gives you all trades, long trades, and short trades in three nice columns. You can see all the different performance metrics here on the left. And then if I click on the drop down here in the upper right, if I select analysis, this gives me the equity curve for the strategy. It also shows the different periods of the strategy with some metrics there as well. You can see the different executions. This is the trade by trade list for all the trades with that occurred historically in the chart. And I'm sorry, executions is the orders that were placed during the back test. Trades actually shows you each of the trades that were made. There were 16 trades in this back test. And basically that's the idea here. So let's go back to the summary page here. And Tom, let's talk about some of the key performance metrics that strategy traders need to kind of zoom in on.
Right. And I think it starts off great with this list, right? Total net profit. I mean, this is the bottom line, literally. This is your balance sheet. This is, are we profitable or not in this simulated mode, according to the history, had we traded this way? Of course, with back testing, it can't ever be, we can't go back in time and test it, but this is representative of the data that we have, the historical data. And so that total net profit reflects, is this strategy at least profitable or not? Is it something that we should continue pursuing? And then breaking it down into long trades and short trades on the right helps us determine which, if there's anything we need to know about the long trades or the short trades. Is there a difference? Right now, I can see that even though we're profitable overall, the long trades very much outweigh the short trades. Long trades are profitable, short trades are not profitable. And then you just kind of delve a little bit deeper into, well, is it an equal match? Is it the long trades are more profitable than the short trades? In this case, they are. And by how much? And is that acceptable? Now, you could stop there and you could say, well, that's a great way to evaluate, but there's so much more to this that you're missing out. And, total net profit is, to me, is like I look at it and see if it's red or black. And that's really not my total concern. What I'm more concerned about is some of the deeper analysis. Percent profitable, I think, is one that we should take a look at. And, that's something where if you go down to the third section, you get the total number of trades. There were 16 trades. 50% of them were profitable. So that's like a coin flip. How are we so profitable when we had half the trades losing? Well, that's kind of like trading, right? You don't have to be profitable on every trade. You can be profitable on half the trades as long as those that are profitable outweigh the ones that are not profitable. That's fine. So it gives me a sense of how successful will I be if I traded just like this. One out of every two, I'm going to win. One out of every two, I'm going to lose. I have to manage my expectations if we said, this is my system and I want to use that going forward.
Yeah, that makes perfect sense. In my mind, I agree that net profit number kind of just says, is this worth looking at right now, or should I try something else? Should I try another symbol, another interval? But even if you have a good trade net profit, there are so many other elements that go into the tradability, in my mind, for a strategy, including, as you brought up, that percent profitable. I think that's a key one for me. One of the key metrics here is, if you come down just a little bit more, is that average trade. So what average trade means is that whether you have a winning trade or a losing trade, every time you put on a trade, you're putting $1,200 in this case into your pocket. Some trades will be winners, some will be losers, but over the 16 trades, I put $1,200 in my pocket on average. So that's an interesting number. And if when we look at whether a strategy is worth trading or not, the question is that average trade worth the amount of risk that I'm putting into that trade? So what is the margin for this symbol? And how much money do I have at risk? And for how long do I have that trade on? Oh, how many days is a daily chart? So it's a swing trading strategy. So I'm risking X number of dollars to make $1,200 per trade. There's a lot that goes into that calculus.
Oh, I completely agree. That average trade, when you talk about risk, sometimes it's not about what you want to risk, but how volatile the market is. So you might be trading at a time where there's higher volatility versus lower volatility, and you have to adjust your risk parameters accordingly. And it might not be worth to take the trade if your risk is too much. If you're only going to make, let's say, only $1,200 on this trade in this example, well, if the market could go against you twice that much, is it worth it? That might be something to think about.
And we'll talk about that risk a little bit as we go a little bit further into this session, when we talk about equity curve analysis and that kind of thing. I want to go back and touch a little bit on this concept of tradability, because there's one of the other performance measures that I think is really important to me is this row that's called maximum consecutive losers. So that's an interesting number. And in this case, it's only two. And this strategy over 16 trades only had two losing trades in a row. But very often, you'll have a really strategy that looks really good, but it'll have 4 or 5 losing trades in a row. And you have to ask yourself, am I able, emotionally, to trade through 4 or 5 consecutive losing trades and then put on that next trade? Do I have enough confidence to put on that next trade? So I think the answer for most people is no. If I've lost 4 trades in a row, I am not putting on that 5th trade. I don't care what the strategy performance report is telling me. So that strategy, in my mind, is not tradable. So even though it's a great strategy, has a great performance report, unless you're willing to actually let the strategy play out, you don't have a strategy yet.
Completely agree, Mike. That is a great point, because that addresses the emotional point of trading, not necessarily your P&L or your account balance or anything. It is emotional. And one thing to think about too is we're only looking to the beginning of the year, and we know that this year has been a bullish year. We also want to test further back, maybe incorporate more data back to 2023 or 2022, which was bearish, And those statistics will change. Of course, the P&L will change because we have more data, but also the consecutive winners, consecutive losers might change. So this goes back to that idea of testing on different data sets, meaning time periods, or in making that time period to that time range bigger to see if that is consistent. If I go back 20 years and I see the maximum consecutive losers is still 2, well, I'd be very surprised. But if that's the case, then I feel better about the robustness of the strategy.
Yeah, it's an interesting point because a lot of times when you're looking at the strategy in these kinds of things, in this case, long trades and short trades, right? If you look at this strategy, the long trades have done well this year. Well, well, of course they have, right? Because we're in a long-term uptrend all year. You would expect the long trades to do well and the short trades not to do well. And this goes back to another philosophy that I have, is that you don't have to trade long and short. You can just trade a strategy long or just trade a strategy short, depending on that market environment. If you're in a strong trending market, bonds tend to trend well. If it's in that, in a downtrend, why would you try to buck the system and go long? And of course, the timing of when you're trading a strategy long or short, or you're trading it just long or just short, that is on the trader to make that decision. But I just want to be clear that I don't believe that you have to always trade long short. You can trade, the market that you're looking at.
Right. So many times we hear traders say, I love a short market, or I love to be long. And you could have your strategy reflect that. I look at a stop and reverse system, Mike, especially talking about technicals, as a way to evaluate the technical study that I'm looking at, that I'm using, not necessarily to look at the trade that I want. If I find that this does better in long trades, regardless of the overall trend, then I might incorporate just this indicator when I'm trying to get out of a short or into a long position. And so that might go into another strategy I test. So, we can be pretty flexible with our intentions with these long, short data that we get with these analyses.
Yeah, I agree. One of the things that traders look at very often is things like profit factor. You talked a little bit earlier about the percent profitable. One of the things that we've learned over the years is that different types of strategies have different kinds of performance profiles. So in my mind, for example, Tom, and I'd love to hear your opinion on this, trending strategies typically are right 45% of the time, and counter trending strategies are typically right about 55% of the time. And of course, there's a wide variance in there. But the idea is that if I come to this performance report and I'm looking at a trending strategy, 50% is pretty good. Because normally it would be 55. If this was a counter trending strategy, I would think that percent profitable is a bit underwhelming, right?
Right.
And same thing with profit factor. A counter trending strategy has a profit factor usually closer to 1-to-1, whereas a trending strategy might have a profit factor of 1.5 or 2-to-1. So the performance report is dynamic to the type of strategy that you're trading.
Exactly, exactly. And this is one way to compare strategies, whether it's different strategies using different signals or the same strategy over different time periods, to give you a sense of was this, did I tweak this a little bit and make it more profitable? Profit factor goes up. Okay, great. I like that. Or maybe it's comparing different time frames. Wow, this did really well in a consolidating market, but it didn't do so well in a bullish or a bearish market. I'm going to keep that in, back of my mind to think, maybe I only use a strategy in consolidating markets. So that's can be used as a way to compare different strategies as well.
And I think we could also add to that the time frame. Intraday strategies may react differently than swing trading strategies. And again, there may be a different set of performance measures that are more critical to that evaluation.
Right, right.
So, I say this all the time, a picture is worth $1,000. I'm going to go to the drop down up here and look at the analysis dialog. And this is really the equity curve. Can you talk a little bit about what we're looking at here?
So what you're looking at is on the top, you're looking at every trade that was made and the data that goes along with it, which is basically balance sheet type of information. Was this trade profitable? Was there commission? We don't have commission factored into this, but it also adjusts the stats for the averages and all of that. But I think what's really cool is the picture that Mike mentioned on the bottom is that equity curve that every time we trade, we reevaluate what the P&L of that trade was, and we basically add it or subtract it, right? If it's positive or negative. So over time, you can see, um, was this strategy profitable? And looking back at the beginning of the year, this first trade might have happened. It looks like sometime in February. Um, you can see the progression of the equity curve as this becomes profitable. It took a little time to get profitable. It was in March that it got profitable. It went from negative and having the red cloud to green and positive. And you can see where those pullbacks were. If you're profitable, you can see where it turned up. If you're negative, you can see where it turned up and started to be positive. But this represents the P&L over time for your trading system.
The thing we're looking for here is to see that equity curve building new equity peaks as we go through time. And so you can see here the little green dot, that's an equity peak up until that point in the strategy. And then this one is a little bit higher. This one's a little bit higher. Of course, this one is much, much higher. And that's what we're looking for. We're looking for consistent equity, higher equity peaks throughout the historical back test. The other thing I want to just kind of touch on is we hear the term drawdown all the time, right? What is the drawdown for a strategy? And the maximum drawdown for a strategy is a measure of risk. And the way we measure that risk is by looking at these equity peaks and seeing how far we've drew down from the last high equity peak. So here you can see we drew down a little bit here, but this equity peak seems to be the biggest one where we drew down from a higher peak to a lower trough. And so if you measured from there to there on the summary page, that would give us that actual dollar amount as the maximum drawdown for this strategy. And when you're trading a strategy forward, right? This is your guide. This is what could happen as you start trading this strategy forward. So it gives us a measure of what the potential risk is as we start trading this forward.
Right. Very good. Very good explanation. And it also, that could be out of the gate, right? If you know that the maximum drawdown is X thousand or X hundred or whatever your scale is, then that could set your risk for the beginning of the trade, the start of your trading a system, right? You could have a situation where you have, like Mike was talking about, number of consecutive losses. You could have 4 consecutive losses, and if that exceeds your max drawdown on the test, it might be time to look for another strategy. But if it's underneath that max drawdown, maybe that gives you some confidence to put that 5th trade on that you might have been scared to put on earlier.
Remember that, when you're looking at a strategy like this, we're looking back from February until now, so 7, 8, 9 months. In order for you to realize this kind of performance as you trade forward, you have to trade this strategy for 9 months in order for this to play out into the future. And you never know where you're going to start out when you start trading this forward. You could start out anywhere on this equity curve. You might start here at the trough and have a great run up, or you might start trading at the top of one of these peaks and have an immediate drawdown. So you have to be prepared for entering at any point on this equity curve, and you have to be prepared to follow through on every trade that this strategy gives you over the next 9 months in order to duplicate the performance that you see here in the chart.
Right. I think it's very important to know past performance is definitely not indicative of future results, right? Just because we tested over the last 9 months or the last 9 years the next 9 months or next 9 years could be much different, right? And so even though we have all this great data and great back testing, we just have to realize that the market isn't something we can predict to a decimal point. So we have to just realize that these statistics will help us in case the strategy does go a little awry. You can still trade your way out of something, especially if you know something like the max drawdown.
So, to Tom's point earlier about robustness, this is why we test on different time windows and different amounts of historical data to try to find a result that is as robust as we can make it moving forward. Tom, I'm going to go back to the summary tab and let's talk a little bit about some of the risk measures here. We talked about max drawdown, but let's talk about on a trade by trade risk measure, which is maximum adverse excursion.
Right. So think of max drawdown as maybe the biggest move where it went against you. It could be multiple trades. Max average excursion is basically how much a trade can move against you, right? So we look at draw. Do we see drawdown on this screen? Yes.
Max drawdown is here near the top,
So you see
and then maximum adverse excursion is down here at the bottom.
that should always be bigger than the maximum average excursion, and it is. So the max drawdown is 8,600. Here, the MAE, or maximum adverse excursion, is 2,700. That's one trade. So that might be another gauge to say, you know what? I know the max drawdown is this, but I also know the biggest loser in my strategy testing was 2,743. So I'm going to use that number rather than the max drawdown on any given trade. And that could be a long trade or a short trade, right? Now, if I want to find out what it is, really the long side is 2,500 and the short side is 2,900. So it's the average of those two. So if I'm long, I have kind of a different level for the max I might lose on a trade, 2,570. If I lose more than that, I should probably get out of my position. And if I'm short, 2,900 is kind of the maximum on the downside. If I get close to that, I might close my short there.
So one of the things you can do with maximum adverse excursion is play with stop losses at that level.
Mhm.
So at 2743, or let's just take the long trades at 2570, if I had a stop loss in this strategy, let's say at 2600, just below that, that means that there could be a trade or two that would have turned around and maybe come back and either lost less or maybe even became profitable. But it also means that now my stop loss is more than my adverse excursion, and I'm probably going to change that adverse excursion number to whatever my stop loss is, because we're going to hit that at least once, right? So that becomes your stop loss, and that becomes the maximum adverse excursion. But you can play with those numbers and see whether it stops more trades out or less trades out around that number.
Yeah, that's a great point. That's a great point. There's some other stats here. I just, they're more interesting, kind of time related, average time in the market, average number of trades per day. Well, that's good for intraday trading. But when we talk about a daily chart, it really means how many, if you invert it, it's how many days between trades on average. So looking at that, it's about 8 days between trades. Max time to recover, 11 days. So you have some time based if you're curious to know, okay, when can I get back in, or when should I get back in? Also, we have up top, we have Sharpe ratio, which is a way to compare, again, another way to compare strategies. It's risk reward ratio type information. And it's just basically saying how well does this strategy perform against just kind of a standard rate of return over some standard deviation? And basically, you're looking for something that's greater than one. I believe greater than one, like 1.25 is considered kind of pretty average.
Yeah, I agree. And again, this strategy is just a very simple reversing strategy. We're not trying to refine the exits here. So yeah, the risk profile here is not as good as it could be if we just started adding some additional risk management exits to this strategy.
Right.
So Tom, we are out of time. This session has gone by super fast, but I think this has been a really good foundational coverage of the strategy performance report and how you and I kind of view the way to look at the evaluation of a trading strategy. Next time, we will be looking at optimization using the market analyzer. So now we're going to actually kind of delve into refining the strategy, making the performance better incrementally as we adjust inputs, we adjust time frames, symbols, those kinds of things. So that'll be a good session as well.
Right. And we'll see that reflected in this sheet, right? In the summary sheet, in some of the other sheets. Hopefully the optimization will give us better results than what we see here. I'm pretty sure it will. But that's really where you're going to do a lot of work in optimization if you're serious about backtesting.
Strategies, I've always said, is an exercise in incremental changes and incremental improvements. And optimization is a way for us to show you how to do that.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.